Joining us right now to talk more about the broader markets is Meghan Shue. She is Chief Investment Strategist at Wilmington Trust, also a CNBC contributor. And thank you for coming in this morning, Elizabeth. Meghan, sorry, Elizabeth Shue. That's what's in my head. Meghan, thank you. Let's talk a little bit about where you see things with the Fed meeting today. I know you're of the opinion that they should cut. And, you know, this is a pretty difficult time for forecasting with what the Fed's going to do just because of the divisions on the Fed. Yesterday, we had former Cleveland Fed President Loretta Mester here, and she laid out the case saying, look, inflation is still above target. Sure, we're worried about the jobs market, and that's kind of where the focus is at this point because that's been the biggest change. But there are some pretty hawkish people who will look at that and say, you got to worry about inflation first. What do you think that means for the markets from that perspective if you have this, okay, we're not sure if we're going to get more cuts after today?
Yeah, when we do think you're going to get more cuts after today. And
what do you think, 3 more next year?
We think 3 more next year, which is pretty much in line with where the market is. And I think if you look at both sides of the Fed's mandate, we are, yes, still above target on inflation, but decelerating slowly, but getting there. And the underlying drivers of inflation, I just don't think are there outside of tariffs, which I think the Fed has generally acknowledged will be transitory and will pass through. Whereas on the labor market, we're still operating in a data fog. So the Fed cutting today, I think, makes sense. Yeah. We've got signs that there is weakness in the job market, especially in smaller firms. So kind of that 2-speed economy with large firms and small firms. And I think that weakness is worth hedging against.
Transitory inflation, you're very brave.
To use that word, right?
Yeah, so do you think that Powell he's going to give lip service to the hawkish cut language? I mean, he'll do that even though he doesn't know, but do you think he also agrees with you there'll be 3 next year, but he's not going to show his hands right now?
Well, I think the Fed not showing their hands shows up in the dots. And then the commentary, I think the market will probably interpret it as hawkish. But I think anytime you get close to target on both sides of the dual mandate and you're getting closer to the neutral rate, which whatever you think the neutral rate is, we're getting closer. I think you have to recognize that the Fed's not going to give that forward guidance that we got so used to for so many years. So hawkish, neutral, what have you, I think it's meeting by meeting, and it depends on the data, which, again, we just don't have great data right now. We're relying heavily on second-tier data until we get basically to the first of the year and get back into the normal cadence.
But you think the Fed is going to cut, and at the same time, you don't think the labor market is a disaster because you don't think the market is topped out here?
I think the market topping out and the labor market are definitely related. I don't think the labor market's a disaster. I think the problem is that we do have reduced supply, which we've talked a lot about. So we're running closer to zero, if you will, in terms of that neutral run rate of of job creation, if you will. So there's less room for error. We're not talking about adding hundreds of thousands of new jobs every month. If the labor supply supports maybe 30,000 net new jobs, all it takes is a little bit of volatility on either side, and you're talking about negative payroll reports, which then spark recession fears again. But I think we are talking about, we are optimistic for next year and looking at not a top in the market anytime soon, more volatility around tech names and non-tech names, but expecting the bull market to continue. And the first quarter could be a little bit of a digestion phase, if you will, maybe rebalancing, maybe some other, global issues, whether it's interest rates or what have you, that sort of reset us. And then I think we move into a better, sort of healthier next leg of the bull market.